if you're buying your own home, you really are concerned about the transaction that's in front of you to get that house. But it's not like that if you're building a portfolio, because you have to think 2 or 3 loans in advance. And the decisions you make today on the loan you get for this property can negatively or positively affect what you do 2 steps down the track.
So Bryce, what we're talking about here is making sure that we don't deal with a transactional advisor. We're dealing with someone who can look after the strategy and tactics and think long-term ahead.
So it's a bit like when you have a client who on paper can actually do something, make the next move, but the bank finds them too risky based on their own policy. So despite the fact they've got the capacity to do it, in fact they can't do anything.
But if you actually divest from that one bank and maybe have a couple of loans there and then a couple of loans over here, all of a sudden that new lender may have an appetite to maybe take you on.
So the key here is to get standalone lending, isn't it? You don't want the banks to have security crossed everywhere so that they're in control. If you can get standalone lending for all of your borrowing, if one bank says no, you can say that's fine. I'll go and chat to the other bank down the road. But that only comes from having the structure right at the beginning, and it only comes from thinking 2 or 3 shots in advance.